How to set up a high probability ratio spread. If you are curious about how to set up a high probability ratio spread, you are in the right place. This strategy can be a great way to manage risk while aiming for profit. Let's break down the details so you can understand how to implement this approach effectively. A ratio spread is an options trading strategy where you buy and sell options of the same type, either calls or puts, but in different quantities. This strategy works well when you have a slight directional bias, meaning you think the market might move a little in one direction. For example, if you believe a stock will go up slightly, you might use a call ratio spread. Conversely, if you think a stock will drop a bit, a put ratio spread would be the way to go. To set up a high probability ratio spread, you first need to consider market conditions. This strategy shines in markets with minimal price movement. If you expect the stock to stay stable or move just a little in your favor, a ratio spread can be quite effective. Next, you will want to select your options carefully. For a call ratio spread, buy call options that are at or near the money and sell out of the money call options. If you are going for a put ratio spread, buy put options that are at or near the money and sell out of the money put options. The strike prices you choose are very important for the success of your strategy. Expiration dates also play a role in your setup. Shorter expiration dates can reduce the risk of significant price movements, but they usually come with lower premiums. On the other hand, longer expiration dates give you more time for the strategy to work, but they involve higher premiums. Understanding your risk profile is essential. Ratio spreads can lead to unlimited potential loss on the uncovered option. Therefore, it is wise to manage your risk by setting stop-loss levels or adjusting your positions based on how the market is moving. Make sure your position size aligns with your risk tolerance and market expectations. When it comes to profit potential, the maximum profit occurs when the stock price lands at the strike price of the sold options at expiration. The profit is calculated as the difference between the strike prices, plus any net credit received when you set up the trade. In practice, use ratio spreads when you have a slight directional bias but expect limited price movement. This strategy allows you to profit from small price changes while keeping your risk in check. By carefully selecting your options, managing risk, and aligning your strategy with market conditions, you can successfully set up a high probability ratio spread that meets your trading goals.